Welcome back to Finance Story. Today's topic is something that weighs heavily on millions of Indian households: home loan repayment. A home loan can feel like a lifelong burden: 20 to 30 years of monthly EMIs, stretching your finances thin, making it harder to save, invest, or simply breathe easy. But what if I told you there's a way to repay your home loan faster without compromising your financial flexibility? In this video, we'll explore how you can use mutual fund investments, especially SIPs, to shave years off your loan tenure, reduce your interest outgo, and build wealth in parallel. So, if you're tired of just paying EMIs and want to break free from the debt trap faster, this strategy could change your financial story in 2025. Let's first understand the scale of the problem. Say you've taken a 50 lakh rupee home loan at 9% interest for 20 years. Sounds common, right? But here's the shocker. Your total repayment over those 20 years will be over 1 crore rupees. That's 50 lakh rupees in principal and roughly 54 lakh rupees in interest. More than half of what you repay is pure interest. Even with the RBI's recent repo rate cut to 5.5%, most banks are still offering home loans in the range of 8.5 to 9.5%, which means your EMI stays substantial. For this 50 lakh rupee example, you are paying around 53,000 rupees every single month. That's a huge chunk of your salary going out, month after month, for 2 decades. It's no surprise that many of us feel stuck, unable to invest for our future or meet other goals. Now imagine you could reduce this burden using your investments. That's where mutual funds come in, especially equity and hybrid mutual funds. These are professionally managed funds that have the potential to generate higher returns than your loan interest. Historically, equity mutual funds in India have delivered 10 to 15% annualized returns over long periods. Even hybrid funds, which combine equity and debt, have clocked 8 to 11% on average. In comparison, your home loan costs you 9%. So if your investments can earn more than your loan is costing you, you have a powerful opportunity. Let your investments grow and then use the gains to make lump sum prepayments toward your loan. That's what this strategy is all about: playing the long-term game with a smarter plan. Let's take a simple example. If you start a 10,000 rupees SIP in a good hybrid fund today and continue it for 5 years, assuming a 12% average return, you'll have around 8.2 lakh rupees at the end of 5 years. What if you used that 8.2 lakh rupees to prepay your home loan? It would bring down your principal and reduce your interest burden significantly. Even better, it could shorten your loan tenure by a few years. And here's the beauty: you didn't have to stretch your EMI or cut into your emergency savings. You just let your SIP work in the background. Now let's break this down into a step-by-step strategy. First, continue paying your regular EMIs as per your loan schedule. No changes there. Second, start a SIP in a suitable mutual fund, preferably in a fund that matches your risk tolerance. If you're aggressive, go for an equity fund like SBI Blue Chip or Parag Parikh Flexi Capped. If you're moderate, choose a hybrid fund like ICICI Prudential Equity and Debt or HDFC Balanced Advantage. These funds are well diversified and have delivered consistent returns over time. The third step is discipline. Continue your SIP for at least 3 to 5 years. Don't panic if markets are volatile. Keep your goal in mind, building a corpus for loan prepayment. After 3 to 5 years, check the corpus value. Use an EMI calculator to see how much interest and tenure you can save by making a part prepayment. Even a 5 to 8 lakh rupee prepayment can shave off 2 to 4 years from a 20-year loan. That's a huge win, financially and mentally. Fourth, repeat this cycle. After every few years, use a portion of your mutual fund gains to prepay part of your home loan. Let the rest stay invested and continue compounding. Over time, you'll bring your loan down significantly while your wealth keeps growing in parallel. You might ask, why not just use fixed deposits or recurring deposits instead of mutual funds? Good question. But here's the issue. FDs and RDs currently offer 6 to 7% returns at best. That's lower than your loan interest, meaning you're earning less than what you're paying out. With mutual funds, especially in a growing economy like India, your chances of beating loan interest over the long term are much higher. That's the power of market-linked compounding. But of course, you need to choose the right funds. For aggressive investors, equity funds like Canara Robeco Flexi Cap or Axis Blue Chip are great options. They've given over 12 to 14% annual returns historically. For moderate risk, go for hybrid funds like HDFC Balanced Advantage, which smooth out market ups and downs by switching between equity and debt. Conservative investors who want less volatility can choose debt funds like SBI Magnum Medium Duration Fund or Kotak Dynamic Bond Fund. These won't beat equity returns, but still offer better post-tax returns than FT. And don't forget ETFs like Nippon India ETF Nifty Dividend Opportunities 50, which currently offers a dividend yield of around 3.5%. These dividends can help you pay part of your EMIs while your investment grows. Always opt for direct mutual fund plans with lower expense ratios, ideally under 1%, and avoid funds with high exit loads or inconsistent performance. Now let's talk about taxation. Mutual fund gains are taxed depending on the type and holding period. If you hold equity mutual funds for more than a year, your gains above 1 lakh rupees are taxed at 10%. For less than a year, the tax rate is 15%. For debt funds, long-term gains after 3 years are taxed at 20% with indexation, which adjusts for inflation. So plan your redemptions accordingly. Also, when you prepay your home loan, remember that you may lose out on tax benefits under Section 24B, which allows you to claim up to 2 lakh rupee of interest as a deduction. If your prepayment reduces your interest significantly, your deduction may reduce too. Weigh the tax savings versus the interest saved when planning prepayments. Of course, there are risks involved. Mutual funds, especially equity funds, are market linked and can fluctuate in the short term. June 2025 saw a 16% correction in mid-caps during geopolitical tensions between Iran and Israel. If you needed to redeem funds during that period, your returns might have been lower. That's why this strategy works best if you have a 5 to 7 year horizon. Don't invest money you might need urgently for emergencies or short-term goals. Keep an emergency fund of at least 6 to 12 months of expenses separately. So to recap, continue paying your EMIs, start a disciplined SIP in mutual funds, stay invested for 3 to 5 years, and use the corpus for lump sum prepayments. Repeat this cycle and you'll gradually crush your home loan without crushing your financial dreams. You'll not only reduce your debt, but also build long-term assets. It's a win-win strategy, and one that's growing popular in India, as evident from the 23,332 crore in SIP inflows in May 2025 alone. Indian investors are waking up to smarter debt management, and so should you. If you found this video helpful, make sure to give it a thumbs up and share it with someone who's juggling a home loan right now. Don't forget to subscribe to Finance Story for more insights on personal finance, investing, and smart wealth building strategies. In the comments, tell us, are you using mutual funds to prepay your home loan? What strategy are you following? We'd love to hear your story.